Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. Let me start with a headline that sounds unequivocally good news. India's banks are healthier today than they have been in decades. According to the Reserve Bank of India's Trends and Progress of Banking in India 2024-25 report, gross non-performing assets or bad loans have fallen from double-digit levels at their peak, over 11% in 2018 to just 2.1% by September 2025. Net NPAs have declined even more sharply, from around 6% to about 0.5%. These are what economists would like to call multi-decade lows. For a banking system that spent the last decade battling stressed balance sheets, stalled projects, and repeated recapitalizations, this is not a small achievement. It marks a decisive break from the crisis years. But here's the uncomfortable truth. In banking, the most dangerous phase is not when stress is visible. It is when confidence returns. And that is why this moment, despite all the good news, deserves closer scrutiny. Let me explain why, using the data. Let's start with the first chart. The long-term trend is visible in gross and net NPAs in this chart. This chart compresses India's last credit cycle into a single visual. What you see exactly rising sharply in the late 2010s is not a sudden accident. It is the delayed fallout of an earlier credit boom, especially in infrastructure and large corporate lending, where projects were over-leveraged and cash flows never quite materialized. For years, banks rolled over loans instead of recognizing losses. Eventually, reality caught up. What followed was not a quick fix, but a slow and painful cleanup. Asset quality reviews forced recognition. Regulation tightened, banks were recapitalized, balance sheets were repaired year after year. Now look at how NPAs came down. They didn't collapse overnight. They declined gradually. In visual terms, the system didn't sprint to safety. It walked there slowly, absorbing losses along the way. That gradual decline is precisely what gives today's low numbers their credibility. A sudden drop would have raised questions about accounting or forbearance. A slow one suggests genuine repair. There's another important feature in this chart: the widening gap between the gross and net NPAs. Gross NPAs show the total stock of bad loans. Net NPAs show what remains after banks set aside provisions. When that gap widens, it tells us banks are recognizing risk early and building buffers rather than postponing losses. This shift from denial to discipline is what makes the current recovery different from earlier false dawns. But low headline NPAs always invite skepticism, and rightly so. The real question is this: were bad loans actually resolved, or were they simply pushed out of sight? To answer that, we need to look at how NPAs fell. Why this recovery is different. Here comes the second chart. This is the chart that gives us this answer. RBI's disaggregated data shows that in the fiscal year 24-25, nearly 43% of the reduction in gross NPAs came from recoveries and upgrades, not write-offs. In simple terms, this means a large share of stressed loans didn't disappear because banks gave up on them. They disappeared because borrowers started paying again. Projects became viable, cash flows improved, loans moved back into the performing category. This distinction matters. Write-offs may clean up balance sheets, but they don't really fix the underlying economy. Recoveries do. They tell us that resolution mechanisms are working and that economic recovery is feeding through to borrower health. Put plainly, this chart answers the skeptic's question directly. Bad loans fell because money came back, not because problems were buried. That is why this cleanup carries far more credibility, in my opinion, than earlier episodes where NPAs fell largely through accounting adjustments. But resolving yesterday's stress is only half the job. The harder task is making sure today's lending does not become tomorrow's problem. For that, we need to look forward. If NPAs tell us about the past, slippage ratios tell us about the future. The slippage ratio measures how many standard or good loans turn bad in a given year. And here the RBI's data is quite reassuring. Slippages have declined for 5 consecutive years, falling to about 1.4% by March 2025, even as overall credit growth has picked up pace. This combination is crucial. Declining slippages alongside expanding credit suggest that banks are not growing recklessly. Underwriting standards have improved. Risk is being priced more carefully. Both public sector and private sector banks show lower fresh slippages. Private banks still have slightly higher ratios, largely because they are more exposed to unsecured retail lending, but even there the trend is downward. Taken together, this points to a structural improvement in credit discipline overall. Banks are no longer just cleaning up inherited stress. They are actively preventing new stress from accumulating at scale. So then, where is the danger? Here is the paradox of banking cycles. Banks rarely fail when stress is obvious. They fail when confidence returns too quickly. Strong balance sheets, rising profitability, and falling NPAs create pressure to grow faster, compete harder, and loosen standards just a little. That is when risks are quietly created. Risks that often surface years later, long after the optimism has faded. We have seen this movie before. Early signs of this tension are already visible. Stress is uneven across loan segments. Unsecured retail credit shows greater vulnerability than traditional housing or education loans. None of this is alarming in isolation, but together it reinforces a familiar lesson. Low NPAs do not mean low risk. The challenge now is not recovery, it is restraint. Stress testing, dynamic provisioning, and close monitoring of fast-growing loan categories matter far more at this stage than celebratory narratives. India's banks are healthier than they have been in decades. The data clearly shows that. But the same data also carries a warning. The last time confidence ran ahead of prudence, it took nearly a decade to clean up the damage. Whether this recovery proves durable will depend not on how clean balance sheets look today, but on how carefully banks behave now that they finally can afford to be confident. In banking, the calm after the storm is often the most dangerous moment. And that is why this phase, despite all the good news, demands the greatest discipline.